Okay, good morning everyone and welcome to FOMC Wednesday. Today is June 17th. Michael Boutros here with you guys. Good to be with you for this live intraday strategy webinar on SB Trade Desk. Eileen, Mark, Steven, Kyle, the whole crew is here. Good to see you guys this morning. So we are on alert for the FOMC interest rate decision, which will be on tap today at 2 o'clock. We'll be looking at some of the dollar crosses. I do want to get as much time for your questions as possible. Look, we're likely to get into this, event risk lull where you don't see too much volatility. Market liquidity starts thinning out ahead of the release. Obviously, hey, Bill, great to see you as well. Obviously, it's all eyes will be on today's press conference with Janet Yellen. Again, we'll be looking to see if we can get any clues as to when the Fed will be looking to hike rates. Let's look at the dollar performance as we go into this event risk. And again, yesterday on the radar charts, I highlighted the dollar index, and that's kind of what I want to start with. So here's what we look like yesterday. We're kind of sitting the same, made a little stretch and overnight trade to the upside, but the major key range, and then we talked about this at length yesterday, so I don't want to spend too much time here, is the 11,887, 11,840. That's really all we need to focus on as we head into the decision today. A break below the lows, specifically 11,839, looks for a target 11,790. That's a 618 retracement. Today, also, you have the convergence of the lower median line parallel on that region. Topside resistance. First, we'll be looking at this median line. I'm not really looking to play the long side per se unless we get through 11,887. And that would probably give us a pop towards 11,836 here. And the upper median line parallel converges on that as we get into tomorrow, basically. So this is the range in focus. Also keep in mind that the opening range for the week is exactly such. Here's Monday's candle. Monday's candle low, 11,839. Exactly the high, 11,889. Just a couple of pips above there. So the opening range for the week is pretty objective. The fact that we have some nice Fibonacci confluences there adds to the validity, and we'll be looking for that range break as we head into the release. Use caution. If you're going to be trying to scalp this release, guys, use caution. It's it's notorious for the whipsaw action. Again, a lot of the reaction that you get doesn't even come out until we get, Janet Yellen taking the stage. So keep that in mind. Looking at relative performance ahead of the release, here's what the dollar index looks like, or the dollar in general. You can see that the CAD, Yen, Kiwi, Aussie, all showing some moves here. A pair from the sterling, which is rocketing 0.52%. If you look at the sterling cross, is really strong today. These a little bit weaker on the session. Aussie obviously came into a low. I actually got stopped out of an Aussie long scalp last night on that move. But in general, you're seeing some weakness in the Kiwi, Yen, and Aussie, biggest losers on the session. Not really looking too much at the euro. It's kind of been a drifter. It's been on the intraday strategy page or the intraday chart page. We'll take a look at that. But really isn't in focus. Again, the euro actually has a really nice range that we're looking to break as well. With the pound, just, we'll take a look at some sterling crosses, but that thing is just rocketing. Obviously, the BOE minutes overnight fueling some further expectations that we might actually see the BOE move on interest rates sooner than expected. In fact, RBS changed their outlook, guys. They were looking for interest rates to be moved in June of next year from the BOE for a hike. That's been brought forward to first quarter now of 2016. So with those interest rate expectation shifts, you would expect to see further fuel here for the sterling rally. That coming into an interesting area of resistance here as well, and we'll take a look at that in a moment. A quick look at what the markets are factoring in as far as interest rates. This is the Credit Suisse overnight swaps, which basically tells you what market participants are factoring and what the expectation is as it pertains to rates. So as you look at this, obviously from the Fed, despite all the clamor that you hear, guys, and all the batter about, they're going to move in June or they're going to move in September, market participants are not factoring in anything from the Fed. Okay, and this is a 12-month expectations. So none of that's priced in. And that's why the impact of these releases can be even stronger, because as it stands, although you're hearing a lot of people saying their expectations for interest rates in September or December, the market are not pricing that in yet. Okay, but if you look at the BOE or the sterling after last night's minutes, looks like market participants are factoring in 28 basis points in hikes over the next 12 months. So again, even if you're going to make the fundamental argument the sterling dollar looks pretty supported even from the expectations on interest rates and the divergence we're seeing right now. So again, don't put too much emphasis on this, and it's not something we really want to stress, but it's something to take a look at for sure. Looking at the equity markets ahead of the open, you see Europe is still lower across the board. Interesting enough, guys, those steep losses we were talking about in the webinar yesterday, the DAX actually rebounded right off support and closed higher on the session. So it looks like we're seeing risk under assault again here. CAC down 1.29%, biggest loser on the session so far in Europe. DAX is down 0.79%. U.S. equity futures also above water, but not by much. You got the Dow up 29 points. You got the S&P up about 2 handles. NASDAQ up about 2 points as well. All right, let's jump into the charts. So do keep in mind, real quick, I just want to also note, guys, tonight you do have the GDP release from New Zealand. So we'll definitely be taking a look at that pair as well. Expected that to drop from 0.8 to 0.6%. First quarter year on year, expecting a print of 3.1. Okay, so some event risk post FOMC, not too far after you get those GDP numbers from New Zealand. All right, so the dollar index, this is where the daily is, the key levels. Also on that radar chart, you might have noticed the scalp chart for the dollar, which has also been very clean. Here's what that looks like. Okay, looks like we made it through that slope resistance from last week's high. Again, resistance or the near-term bearish invalidation, very objective weekly opening range high. Nice confluence of fibs there, and again, 1187 into 1180 resistance. Any questions on the dollar index before we move forward? If you're not trading stateside, this is going to be a nice indicator for you, or a nice possible trade setup here as we get into the FOMC. If you are trading stateside and you can't trade this asset, again, it's going to be a very nice tell for us as far as the base dollar movements. Remember, on this index, at its inception, equally weighted euro, Aussie, sterling, and yen. So the 4 most liquid, most traded currencies versus the dollar. All right. So we're going to skim through euro real quick. I don't think there's any plays here for us yet. This is what we looked like last night. Again, the near-term bullish invalidation level is going to be the weekly opening range low. That hasn't changed since Tuesday. And of course, former trendline resistance, now support. Another slope off the lows there. Nice convergence just below that 1187 level. Here's what the euro looks like now. All right, so that median line, which was the resistance, offered some support on the rebound, and we've kind of just been muttering ever since. Again, the top side break above 112.95, 113. Here's that major key resistance at 113.76, 113.92. On the daily chart for the euro, you can see we've just been alternating essentially up, down, up, down, up, down. Not much conviction. So look for today's event risk to really charge something. Obviously, we'll be listening for headlines out of Greece as well. I'm not really going to stress that story as much because it necessarily hasn't been impacting price on the near term, but certainly with the FOMC on tap, you're looking for a break of this near-term consolidation. And as far as the weekly range is concerned, it's pretty well defined, sub 1330 and above 111.87. The momentum signature hasn't given us much guidance either. We're kind of holding 60-40 here, right in the mid-range. So again, we'll look for either a break of the weekly opening range high to target 113.90, essentially 114, or break below 111.87 really invalidates that long side bias. And if that happens, there's actually a lot of room to the downside, guys. If we break below this, you're going to look for a drop into 110.30, 110.65. You have the 100-day moving average, the lower median line parallel, the lows from May, the opening range low, and that key 618 retracement all coincide right down here. So on both sides of the market, we're pretty well prepped here on euro. I just don't think that we have a play here ahead of the release at 2 o'clock. But the levels haven't changed. So the levels from Tuesday, and obviously we updated those charts last night, those are all still in play. Any questions on the euro before we start to move on? Okay, even on the near-term price action. We was looking at this trigger earlier today before the webinar, but it's pretty tight. You actually would have been able to squeeze out a nice little scalp to the upside, but you wouldn't have gotten the quarter 35 pip ATR that we're looking for. And again, it's likely that you'll see that start to slow down. Aren't we long, says Andrew Willen. If you're on the swing side of things, you are still holding longs, right? Those stops are at 111.85. So on the swing side of things, guys, the stop is below the opening range low, exactly what we just talked about. Okay? That trade hasn't changed. So euro dollar, you guys still would be buyers under 111.50. Mark, no, that would change things for me. So like I said, the near-term bullish invalidation level is right here. How would you trade the breakout to the downside, says Bill Kennedy. Good question. So if we break below 111.50, and if you read the report from Tuesday, or if you read the update from Tuesday, guys, that's exactly what the game plan is. You're constructive above here. So as you pull back, you're looking for long triggers above 11.87. If that gives out, a break below 11.50 is what puts us bearish. So Bill, in that type of scenario, it wouldn't be necessarily a play that we'd play right after FOMC. If it does break down, you'd need to wait for some sort of corrective pullback, and then we'd look to short against 11.87. All right? Does that make sense, Bill? He says, Kate, okay, that was Mark, says, okay, thanks. Remember, when we were playing these breakouts, guys, if the opposite happens and it invalidates our bias, okay, you're not going to want to just jump right in there. Let the market play, let it stretch the downside. On the pullback, then we get in short against the highs. At all times, even when we're near-term trading, it's paramount that you have your stop and your risk well-defined. Okay, so before we jump into the position, where's the stop? How big is that stop in comparison to what I'm looking to make on this trade? Good question, Bill. All right, so that's euro. Let's see if we can clear out of this range around 113. It's been kind of tedious here, so we'll see if we can't get some move here on the euro. Next up on tap was the Aussie dollar. Okay, we made a break of the weekly opening range here today. So here's what the Aussie looks like on the daily. Again, I actually ate a stop on this last night. Here's what the daily chart looks like here. You had a basic trendline support off the lows for the month, or specifically the low that you made there on the 6th, or on the 8th, excuse me. With this move here taking you through the opening range low for the week. Here's the Monday open. Monday open low comes in at 77 handle. Momentum turning over ahead of 50 here. Not really giving up yet. I still think you could find some support here at this lower median line parallel. We'll have to see if that actually offers some support as we head into the FOMC. Here's what the scalp looks like. Again, on a larger basis, same formation that we were looking at on the daily chart, basic trendline support off those lows. Okay, and this is the opening range low for the week as well. So this is the level that we highlighted on Tuesday. Took another day here, finally seeing a downside break into that move. On a 5-minute trigger, there was some divergence here. The trigger never gave out, so I actually tried to press the long. There's a quick 20 pip stop, not a big deal. But long story short, the drop took us right into 76.70. Again, I think if you're on the swing side of things, you might have gotten stopped out on that last stretch. In any event, this is the near-term support structure, and this is what turns us back to that median line parallel we looked at on the daily chart, okay, if it breaks. So the Aussie would need to get through 77 again to get on a constructive approach here, taking a neutral stance heading into the FOMC. But I still do think that you could see some strength here. I don't want to necessarily press it at the lows. We're in oversold condition. As long as that holds, you know, this thing could give us some further pulls. But in general, ahead of the FOMC, I'm not looking to take any new positions on the Aussie. We'll have to see how that release comes out. As far as Aussie data is concerned, you're pretty much limited to the end of the week as well. So the last print that we got of magnitude with those minutes that we saw. So look for near-term support 76.67, 76.70. That's what we're holding right now. Again, it's a basic 618 retracement off the low. This is a longer dated 786 off the advance from the lows that we made for the year back here in April. So really nice pivot in price. See if that offers any support. Bill says, suggest on that. I'm not sure what you mean by that question, Bill. If you want to give me some more background information. Mark saying it was too clean yesterday, right? We were talking about that. Typically when things are too clean like that, something's bound to happen. But in any event, we'll see if this thing gives us some more basing or if we can hold support here as we head to the FOMC. Remember, the low day close or the bigger, broader risk for the Aussie is 75.90, that level that we came into right in the start of the month. Okay, low day close for 2015. Euro. Bill, I still don't understand what you mean by euro on STO. If you want to give me some breakdown there. Okay. So that's the Aussie and the euro and the US dollar, and that's really the focus that I'll be looking at heading into the FOMC today. Looking to see, first of all, if euro breaks the weekly opening range finally. And for the Aussie, I'm looking to see this support here. Possible long entries, if the data is broadly dollar negative. Let's take a quick step back. What are we looking for figuring out what the Fed is saying today? So I'm going to take a quick drill with you. Bear with me one sec, guys. Okay, so here is the projections from the last meeting. This is from March 18th. And this is what makes these interest rate decisions so critical. It's not because, hey, GS, great to see you in the room there. It's not just because we're looking to see if they raise interest rates or not, right? No one's expecting them to move on interest rates. But the question is going to be the projections as it pertains to inflation, growth, unemployment, and interest rates. So as we look here, this is just a quick projection that we get. We'll be looking for to see if those 2015 projections on GDP change at all. Specifically, unemployment has not really been a factor, more so PCE core inflation. This is going to be what we'll be looking for to see if there's any shifts to the expectations for 2015. More importantly is the dot plot, aside from the GDP growth, and interest rate expectations. And this is the thing that we'll be looking for. So appropriate time for policy firming, that's normalization of policy, that's raising interest rates. You have 15 of the 17 members looking for a rate hike in 2015. You only have 2 that are looking for it in 2016. Okay, so the first thing we look for when these releases come out is the divergence here. Is there anyone on the committee who flipped to 2016? Does this move up to 3 or 4 members? And we see that there's a little bit more of a division within, a rift within the committee for people wanting to hold out on rates. So that's the first thing you want to look for tonight or this afternoon. The other thing is the dot plot. And this tells us where the midpoint, as it were, for where interest rates will be over the next near-term horizon. So you can see that in 2015, there's a member who sees interest rates as high as 1.5%, but the majority is in this 0.5% mode. So that basically would give us 50 basis points this year. Okay. As we move into 2016, there's again a couple of members that see rates as high as 3.5%, 4%, but the majority see interest rates at 1.5%, 2%, right? So again, aside from where or when appropriate policy firming is seen among the committee, we'll also be looking to this, and this is really what the market focuses on, this dot plot, because it not only will it tell us when, but it'll tell us the pace. And that's the major thing that we need to focus on, not just when's the first rate hike, what pace are they looking for? Are they looking for, by the end of 2016, we have 3.5 interest points on interest rates, or, is the majority dropping down? And in 2016, you see them mostly at 1%. So he says, poof, those Fed members just throw darts, LOL, says Mark. They're stuck between a rock and a hard place, guys, at the end of the day. And I bring this just as a caveat here, just so you guys have a better understanding of what we'll be looking for when the release comes out. I don't want to necessarily stress this. This data, guys, is good to understand what's going on in the macro backdrop. But my problem is people trying to use this to trade. Okay? This is good because it tells us where the market sentiment will be leaning. It might tell us what the near-term reaction or how the market will react near-term. But trying to to plan a trade strategy around this doesn't make any sense. Okay, so take it for what it's worth. Dan says, great FOMC recap. Hey, Dan, I'm glad you're enjoying it. Again, I just want to make sure that we're all on the same page, because a lot of times the release will come out, we won't, if you don't really have a great understanding of what the markets are looking at, you can really misinterpret what you're hearing from Yellen. So here's the link, just so all of you have it. You'll find it on the question box there. I just sent it through. Dan says you've got to at least have an idea of what's going on. Exactly, Dan, exactly. So the first thing you do as soon as you get the release, guys, is just come to page 2 here on the figure 2 and just check out what the dot plot, if there's any divergence, and the appropriate time of policy firming. These are the 2 major factors that markets will tend to move on: the pace and the timing of policy firming. Okay, so on that premise, so now that we have an idea of what we should be looking for, looking at the dollar index, hey, it's not too shabby, right, of a setup. We're right between 2 major levels. We know exactly what we should be looking for as far as what the members ought to be moving on. And again, remember, we have pretty good job strength. CPI data comes out tomorrow. So of the Fed's dual mandate, the laggard has been CPI, and of the data prints that are coming out this week, that's going to be the most important one that we see tomorrow morning. So, you can debate, does the Fed already know the numbers or not? I don't really care. I'm not going to get into that conversation. But certainly on the back of what we hear today from Yellen, and specifically she notes concerns over inflation, we'll put a little bit more emphasis on tomorrow's print. As it pertains to Yellen's comments heading into the release, just a quick note on that. If the Fed is to give us a little bit more of a hawkish stance, remember, we just talked about the laggard being inflation, right? If they start to hint that they will be moving up on rates, what's that going to do? Okay, it's going to hurt, or it's going to hurt risk. You should see stock markets start to sell off, because remember, if interest rates rise, demand for riskier assets starts to fall because you can get a yield, right? And with the same respect, that saps liquidity from the market. So if they hint that we'll see interest rates moving higher this year, or that they're still on pace to do that, that's only going to propagate further dollar strength. And what does that do? That slows down inflation, which is what the Fed is targeting. So you can see that the Fed is in a really tight spot. If they start saying we're going to move on rates, that's going to prop the dollar more, that's going to slow down inflation. If they say that they're not going to move on rates, great. Markets should react positively, or at least stay supported, and the dollar should continue to depreciate, which would stoke inflation, right? So it's kind of a catch-22. Whatever way they take, all these calls for higher rates may not be the best idea. And great point, Mark. Great point. He says, and besides, that would be going against the IMF recommendation from Lagarde. You're absolutely right. I think it's going to be interesting today during the presser to see if someone questions her on that. Because here's the thing we need to keep in mind, guys. If the Fed admits that they're going to hold off on rates, and one of the reasoning is because of the IMF, that is not going to be something good for the Fed. Okay, because the Fed wants to maintain its solidarity and their independence, and if they start to suggest that they're taking direction, or that they're reacting to international or macro calls from the IMF for them to hold on interest rates, that's not going to be a good sign for the credibility and the independence of the Fed. So, Mark, I don't actually think that she's going to use that as a reasoning, or even suggest that was any part of the decision. But I hear you 100%. I hear you 100%. Even if they don't admit it, it's definitely, they're coming under pressure to hold off on rates. Remember, guys, RBNZ just cut. BOJ's easing. ECB's easing. It's very difficult to justify moving higher on rates right now. Although, if you ask me personally, Michael Boutros, I think we should have raised rates 6 months ago. That being said, I'm not developing policy, or I'm not we're not in the business of trying to develop policy, so we're just going to focus on what the market's doing and how we can trade it. So I hope that kind of background or backdrop, guys, give you some clarity, give you a little bit better idea of where the market is positioning and why this interest rate is so critical. Again, it's not just if and when, it's the pace. And is this going to be the start of the normalization cycle, or just a one-off sort of off the bow type of toss? So does that make sense, guys? I hope that helps. Kelly says, could I trouble you with the Aussie dollar? I need one last look. Thanks with your guidance. Yeah, sure, Kelly. Is there something specific? The 30-minute chart or the daily chart? Let me know what you're looking at. I'll be more than happy to review that for you. Mark says exactly, they would never admit it. Yeah, I mean, if you guys remember, there was a situation very close to that with the ECB. And again, these central banks, it's paramount that the market, I don't know, I'm trying to choose the right words here. It's paramount, their major objectives that they need to make the market believe, and they need the market trusting in the fact that they are independent, okay, that the decisions these central banks are doing are irrespective of external pressures and are completely based on the domestic situation. And that's what every central bank tries to foster, that view that, guys, we don't care that the IMF said this. We're doing what's best for the U.S. economy, and right now we need to hold on rates, or we need to move on rates. They're never going to admit that there's something else filtering into that decision. But surely, as logical beings, we know that that's probably not the case. Bill says, amen. I'm going to take that as a positive. Mark says, I agree. I want to bring my US dollar to Europe. LOL. Bill Kennedy says the average rate for the last 60 years is 5.2%. Bill, great point. And there's been a lot of bank research that has been suggesting that we may never actually see 5.2% again. I think that would be a travesty, but irrespective of what I think, it's very difficult to see them going anywhere near a 5% anywhere over the next 2-year horizon, just because of the global environment. Right, Bill? So absolutely right. It's unprecedented, guys, by the way, where we are in interest rates. And for the duration that interest rates have remained at zero, we've never seen this in history. So we are setting a precedent right now. So it's hard to go back and use any other analog to try to gauge what time is appropriate after 6 years of zero rates. It's never been seen before. Kelly says, thanks. A 4-hour chart. Not sure if we are going lower or up from here. Kelly, we never really know, right? The best thing we can do is position ourselves so that we're in a best scenario, so that when the market does move, the risk to reward is there. But here's what I can tell you. First of all, I would caution you about trying to make a decision like that right ahead of FOMC, because once that event risk comes out, Kelly, all near-term technicals go out the window, because it's sheer market reaction. So if you're looking at a 5-minute chart and you're trying to figure out triggers during an interest rate decision, it can be a very, very dangerous affair. Okay, so right off the bat, I tend to take a much more reserved stance, Kelly, right ahead of the release. If I don't take a position into the release, or if the release doesn't give me an opportunity to take a position, wait the market out, let that noise clear out, let the whipsaw action clear, and we'll get more clarity, and we'll take a position at that point. Don't feel obligated or compelled to take a position, guys, just because there's volatility. Volatility is a double-edged sword. It can help us as much as it can really screw things up. So we want to take that into account, and also keep in mind that this is probably the biggest event risk for the month, even more than the NFPs, because again, the employment picture is not really what the Fed is focused on, right? We're pretty close to nominal, quote-unquote, employment. So keep that in mind. And Mark makes a good point. If you're new to Forex, or if you're new especially to near-term trading, today's not going to be the day that you're going to want to start delving in, right? I always encourage people, excuse me, especially if you're just trying to get your legs with this, you have to be in front of a computer and you have to watch how the market reacts. Because watching the reaction of these types of events time and time and time again, inherently you'll start to get a little bit more of a knack on how to play them. Bill says, I found to wait until early eve or the next AM. Yeah, Mark, absolutely. You know what I like to wait sometimes, Mark, is for the Asia Open, especially if you see, yeah, he says, is that okay? I would say the Asia Open is where I like to really see either follow through or a pairing of that move, right? As U.S. markets are closed, Asia comes online. They're reading what the FOMC said. They're interpreting Yellen's results, and either you see a continuation of that move or you see the market start to pair some of it. So GS is saying move to London. Oh, trust me, I'm almost there, GS. All of my setups have been panning out in overnight trade here. It's very frustrating for me, but we'll see. All right, so I think we've kind of given we've kind of made a nice little overview of what we're expecting today. Kelly, did I answer your question on the Aussie, or if is there something that I missed, or if you have a specific question? I want to make sure I get that. So I'm not sure if you missed it earlier in the session. The near-term support, 76.67 to 76.70, Kelly, is what I'm looking for. And again, a nice 618 retracement just off the range lows for the month. And again, the momentum signature broke below 40 for the first time this week here on this move. So as soon as we broke below this, it should have been the indication to lay off the longs. Again, my stop was just right here at 77.10. Actually, I'll show it to you. Right at 77.10. So as soon as that level broke, we just jumped out of the trade. Good thing, because this thing tanked another 40 pips to the downside, 50 pips to the downside before all said and done. Okay. By the way, Aussie Dollar held by 0.2 pips, the stop from Jamie. Oh, awesome. So as far as the swing trades are in, you guys are probably still in there. Yeah, the low was right off. The low is 77.69 too. So if you still manage to squeeze past that, I'm not really against necessarily still seeing the Aussie rally. And guys, there's a couple of reasons for that. We're not just trying to call lows. And actually, I'll bring your attention to the euro first. So obviously, you guys know we're still with FXCM, me and Jamie. There was a larger client that we spoke to, or that I spoke to yesterday, who was holding along on the euro dollar, and his argument was, are we, am I at risk? Is this really a bad trade that I should get out of ahead of, with all this Greek debacle happening? And listen, he has a really good average rate from sub 110. And the argument that we've been making for the long side of the euro, guys, is not just trying to call lows and trying to fight the consensus or the sentiment trend that's bearish euro. We've gone over this. I know Jamie's talked to you about it as well, but there's a lot of things that are changing, from the momentum profile, from what price action's doing, even from an Elliott wave standpoint. You seem to have real five wave clean advances to the upside. Even this last stretch looks like a 1, 2, 3, 4, possible 5, in which case we could be in correction. But even that pullback, you will look to buy eventually. We're still within this formation. Momentum turned strongly positive with that break we made back in April. You've been getting multiple oversold, hold at 60, oversold, hold at 40. It's real strong downtrend. Again, oversold. Once you break 40 to the upside, and here you are testing 40 support, now there's some room for caution. You made some divergence on those lows. Price action pressing into a much steeper low as the oscillator holds equal lows. And then you have support at 40 on the rebound. Once you get back above 50, that was the first 50 break you saw in the euro from oversold conditions since, I don't know when, since way back here. From oversold to the break above 50. And you can see, right? Not too different from what we're doing right now. A little bit of a basing, topside break. And you saw a really strong rally right into the end of the year. Not saying that's what we're going to necessarily see for the euro, but near term, it certainly causes some caution for the short side of the trade. So keep that in mind. Again, major key resistance 113.90, basically the 114 handle. 114.75 is not only the 1618 off the low, but it's also just pips off the stretch high from last month, which actually came in at 114.65. And if the euro was such a travesty because of what's happening with the Greek crisis, we wouldn't be trading off these levels with almost 1,000 pip rally off the low. Eileen says, I too have given strong consideration last couple of years to moving to the UK. Eileen also says, no, don't leave us yet. Yeah, no plans imminent, Eileen, but I will keep you updated. And even if that were to happen, we'll still be on board. Kyle says, glad to hear it isn't just me with these London breakouts. The sleep deprivation is killing me. Risk and reward, Kyle. Everything in life is risk and reward. I always think that to myself when I'm looking at a setup that might pan out and I'm really, really tired. I hear you. And again, that's why it's great when the positions that me and Jamie are looking at line up, because if they do, that's all the more conviction. I'm not really one who likes taking entries on limit orders. I'll take profit and take stops, no problem, but I'd like to be at the market, with the market when we jump into position. When our levels line up as cleanly as they do typically, a little bit more comfort there trying to place a limit order to try to get into the trade. Heading into event risk, keep your hats on and keep focused with the markets here. We don't necessarily want to make any assumptions until we see what the release comes out. Despite everything we just said, guys, I want to take one step back and say one simple thing. Very rarely, and you've heard me say this before, is one event risk going to shift, reverse, or break broader trends. Okay? If anything, it offers you an opportunity, okay, to get back in. Meaning, if the dollar shows us a super strong rally right off the release, it comes right into 1187, then all of a sudden, deeper into the conference, you start hearing her say, oh, well, there's concerns about inflation slowing down and yada, yada, yada. Whatever it is, if she starts to push out interest rate expectations, that might be an awesome opportunity to get back on the short side. If she says something much more hawkish and this thing breaks through, no problem. Still, we can play the long into the resistance level here on a pullback, but doesn't mean the entire trend has reversed or broken or anything. It's just a near-term correction. You'd still be looking for resistance into 11,936. Okay. Barring her saying we're moving on interest rates in June or September, we're going to hike. That's sort of the game plan. So keep that in mind. Very, very rarely are we going to see a broader reversal in trend. If anything, they can trigger corrections. They can trigger near-term movements against our bias. But the length of time of which that effect will have on the markets will rarely be something that's much more lasting. Mark saying, and if there is a lot of volatility, brokers will not be able to execute your exact stops. That's another thing to keep in mind. Whatever broker you're working with, guys, it doesn't matter. I've been on the bank trading with Deutsche, Saxo. It doesn't matter. Once these events come out, and especially during the presser, if she says something that is off the cuff, if you guys remember early in her career, Yellen, and I laugh when I say this because I remember when it happened, my jaw dropped. They were saying, for QE, when we were going to wrap it up, they were saying, what does a reasonable or considerable amount of time mean? It was literally her first press conference as the Federal Reserve Chairman. And you heard her stutter for a couple of minutes, and it kind of off the cuff, she threw it away. She threw it out there. She said, yeah, reasonable time period, 4 to 6 months or something like that. She threw out a time frame. Literally, the market took that as that's when we're pricing it in the end of QE. And you saw a massive reaction. I think she's sort of learned her lesson at this point, and it's unlikely that she'll throw off the cuff comments like that. But those are the ones that you need to be aware of for real strong, instant market volatility based on that. So during those scenarios, guys, no matter what broker you're with, gaps happen, and certainly slippage happens on stops all the time when you see massive event risk like we're going to get today. So keep that in mind. Good cautionary note there from Mr. Haberman. All right, so we've gone over some of the majors here. We're running low on time, so I do still want to cover a lot of the other ones. Let's go over real quick where the dollar CAD is. That was on the radar charts earlier this week as well. By the way, all these radar charts are still in play. So remember yesterday we went over Euro Key and Sterling CAD. Sterling CAD actually held that high day close. But let me stay on topic. Here's the dollar CAD first on the daily. So this was on the radar chart on Sunday night. I don't really necessarily have a play here so far this week. I haven't done anything on this, but what I wanted to see is if we hold below the opening range low. So if you recall last week with the break below 23.85, we turned bearish on the pair. That took us below the median line support. That took us below, again, this major pivot just below the 124 handle, which is the stretch lows for the April opening range, and the close lows that we made for the February month, which was just a consolidation month. And it was also the opening range low for the initial open for June. So we've kind of been straddling that. Okay, on a closed basis, it looks like we closed below it, and we've been holding it as resistance. Okay, and back into focus is that same median line off the highs. So today will be a pretty interesting day for the dollar CAD. If we hold below this, I'm still looking lower. Momentum coming into a resistance trigger. So you have the invalidation. If this thing breaks through to 23.85 back above that median line and momentum clears the trigger to the upside, you're likely to get a correction back towards, first target would be, or once you cleared that 100-day moving average at 124, the first target would essentially be the high day close for the month, and that's 100 pips off. A downside break of the weekly opening range, which has been very, very tight, and you're essentially looking for a drop into 122. Probably put a soft target here. Let me just add this on real quick, guys. Pretty clean. So we already made a 50% retrace of that move. Yeah, we can leave that 786 there. Not bad. And at this point, we can move this 38.2 as well. Okay, so this is what the intraday chart looks like. So there's that same median line that we were looking at, the median line parallel on the daily chart, which has held as resistance. One extending off the highs has been kind of messy. The lower median line parallel caught the low almost to the pip. The median line itself has been a very nice pivot in price, getting a little messy up here, but heading into the event risk, the focus still is on, excuse me, that 122.80 level of support and 123.65, 123.80 as resistance. For the dollar CAD, keep in mind that you still do have some event risk on tap for the end of the week. So for dollar CAD, you do have the CPI data, which comes out on tap on Friday, as well as retail sales for the month of April. So a double whammy there for the Canadian economy. Obviously, we're expecting a pretty decent uptick or a pretty decent rebound in inflation. And again, if that tends to be, or that turns out to be the play, you could actually see some CAD strength, which would only help and propagate further dollar CAD weakness. All right. So dollar CAD, again, kind of a drifter, but a very well-defined opening range. And we'll be looking, again, for either a break below 122.80 or that break above 124. I want to highlight this region real quick. Right here. Again, just as a reference, we have a lot of new clients that have been signing up, guys. If you are new to the webinar, you can always click on the camera in the top right-hand corner of your GoToWebinar screen, and that'll allow you to take a free shot of any of the charts that you see here. So if you need it for future reference or if you're trading these levels, please feel free to do that at your leisure. Eileen saying, will Jamie and maybe you be on during the presser? We'll be on Twitter for sure, trying to give you updates on what's going on. I'll be highlighting any major key comments that she makes as well. Guys, I'll be highlighting that on MB4X and SB Squawk too, so you'll be able to follow on both of those. But I'd be cautioning you on the presser because markets sometimes will react to a little word that she slips out or something like that. We're going to want to see what the broader message is. And again, for me, more so, it's going to be the initial projections. That table that I just showed you guys. That's going to be the real focus here, is what shift happens to these dot plots and expectations on timing. Eileen says, good, sounds good. I'm reserved, thinking I'll stay flat this time. And again, Eileen, there's nothing wrong with that. Flat is a position, as Mark always likes to say as well. But I don't go in with any expectations. You know, I have my levels mapped out. I want to see what the reaction is to the release. And if there's a position and there's a favorable risk to reward entry, Eileen, we'll take it. If there isn't, we don't. You know, I never try to set that expectation for you. And I get that question a lot in the webinars on Daily FX. People will be like, hey, are you planning on trading this? I don't have a plan to trade it. I have a trading plan. But is that plan necessarily going to play out during the release? I don't know. I have my levels mapped out. I know what my broader bias is. I know where it's going to be invalidated, and price is going to decide whether I trade or not. Right, Eileen? Not me. If price comes into resistance and we see that the release is actually not hawkish and the dollar rallied into resistance, I got no problem fading that. If she comes out and says, guys, June is the month, and the dollar sells off and the dollar's at support, I got no problem fading that to the upside, right? Price is going to determine whether I'm going to place a trade or not. So just a quick note there. Eileen says, my hesitation is deciding where to jump in and when the move happens. So the where to jump in, Eileen, we should know that before, right? That should never be something that you need to think about at the time of trade. We have our levels mapped out. Is price at that level? That's all that matters to me, right? Is it going to continue through or is it going to rebound? That's going to be based on timing, okay? But where you're looking to operate, Eileen, that should be determined beforehand. We have everything mapped out, right? I know the levels for Euro. I know the levels for Aussie. I know the levels for dollar index. If price gets to one of those levels and it's contrary to what the message that the Fed is sending, I'll be more than happy to fade that move. I don't want to, again, I do not want to extrapolate or set guesses, but if you had to put a gun to my head right now, if someone had a pistol to my head and said, Boutros, what do you think is going to happen? I would suspect that you would see a rally on this. Typically, the dollar will like what Yellen has to say because everyone keeps interpreting everything she says as rates are moving higher. Rates are moving higher. If it's a more conservative approach or a more cautionary stance, that would be where I would look to see that break below 11,839. But I would suspect to see, maybe the dollar rallies into 1187 or even higher, and then just starts to sell off. It's in a downtrend, right? Unless she's excessively hawkish, and that would just, you might see a break right through 1187, and then, I don't think we'd be able to get in. I don't think I'd be able to play that scenario if we break through this. If we do break through this, you're probably going to see this thing run right into 11,936. Base case scenario, again, I'm looking for the break below to look for 11,790 here. So we'll see what Yellen has for us. Hopefully we get some fireworks today, guys. It's been kind of a quiet snoozer session here since the start of the week. Let's see if we can get some extra volatility. Like the extra discussion with this, really helpful. I appreciate that. Thank you very much. And again, it's for your benefit, guys. So feel free to throw out any questions you have. There is no taboo. We went over dollar CAD, dollar yen. How can I forget? Goodness gracious. Dollar yen's typically your biggest mover, your biggest reactor, as it were, to broader U.S. data. And we're coming into an area of very interesting resistance, guys. Me and Jamie were talking about this at length. I'm looking for 124.35, 124.13, maybe a tad higher from 124.35, depending on if we go for a tag of that median lines off the lows for the year. But still looking lower below this region. Again, very similar to the euro dollar in that even if you look at it from an Elliott wave standpoint, it looks like a 1, 2, 3, 4, 5. Even on a simple correctionary stance, you'd expect a deeper cut, a deeper pullback below 122 just to complete some sort of correctionary move, and then we start to move back to the upside. So I'll be looking for possible short entries as we get into this region. I think it's the best way to play the dollar yen, and specifically the major resistance is going to be your high day close, which should be, I'm not sure why that is not snapping correctly. There we go, 125.56. Okay, and that was the high that we made this month, and that's for the year, multi-year, right? So that would be sort of the major breakout that would get you back on the continuation. Remember, we talked about this earlier last week, guys. The conservative measurement of the consolidation that we were in here for the March-April calendar month, that target's been hit. That's 25.70. The more aggressive approach or measured move, if you take the wider low that you made for the year as the consolidation, okay, that gives you a measured move into 128.18. So yeah, the broader buy still is weighted to the upside. The question is the correction off that 125.70 level done? And for me, 124.35 is going to be the near-term bearish invalidation level. As long as that level holds as resistance, I'm looking for short triggers in dollar yen. All right. Bill, yes, we will not go anywhere without checking Kiwi. Thanks for reminding me, man. Here's what the dollar yen, before we do, looks like on the intraday charts. These levels were also actually highlighted on the radar on Monday. Actually, I'm sorry, the intraday levels weren't highlighted on Monday. The intraday levels were highlighted last week. But if you go to the scalp log from the week ending June 12th, that chart is here. Either way, guys, feel free to take a snapshot of the picture right now, of the chart right now. This is the formation that we've been working with. We had some median lines that we were working with last week that mimicked this slope, but you can see we've broken, tested a support, and we've kind of moved off at this point. So 24.15, again, 24.50 is the 618 of the decline, and again, just above, right here, just above that region that we noted, 24.35, 24.50. So in fact, at this point, it might be worth it for us to drop. It's the high here, 24.15. No, we'll leave it. It's a stretch high here from the 11th. So just note this key region, guys. Above 35, there's 15 more pips to the upside room here where you could go for a tag of that 618 before it turns over. But broadly speaking, looking to see if we can find some resistance here in dollar yen. All right. Any questions on dollar yen before we move on? All right, let's jump into the Kiwi dollar. So I don't really have anything on this bill to add to what we said yesterday. If you recall, yesterday's webinar, we kind of went over this. I'm not really looking to do anything unless we saw a tag of that resistance at 70.37, basically the close low and the median line off the high. That's sort of where I wanted to reshort. We never got there yesterday. Other than that, you need to wait for a tag of this major, huge resistance support cluster, into 68.75, 69. You have the S1 monthly pivot, which again, I don't stress monthly pivots, but when they coincide with longer-term Fibonacci levels, longer-term moving averages, or trendline support or resistance, that's when they become much more critical to me. So you have the S1, which is 68.87 or 68.90, let's call it. You have the 1618 extension off the high, which is at that same exact level. You have 100% extension from the decline off the highs in July. And then you have a 50% retracement from the advance off the lows you made in 2008. So you have a huge cluster here of support. Add to that the current operative slope, lower median line parallel, also extends right to the bottom of that range. So this is the first area of which you'd expect to see some possible resistance, support. I'd be looking for long exposure here from a scalp standpoint. Below there, and sayonara, man, there's a lot of room to go. Remember, the whole premise of the Kiwi breakdown, guys, is based on this, right? That lower median line parallel, again, the slope of which dates back to the year 2000, saw a major break, a test, a run through earlier in the month, and then that massive day that we made on the 11th really validated a break of that. So you could get a bounce from down here, which would offer a nice rally back towards the median line. That'd be the first objective. With the broader bias obviously remaining weighted to the downside. Remember, guys, that we just looked at Credit Suisse overnight swaps, and they're factoring in, what, another 50% chance for a basis point, for a 25 basis point cut. Again, this is Credit Suisse overnight swaps. For the Kiwi, they're still factoring in a 52% chance of a 25 basis point cut next month. 12-month expectations are still calling for 40 basis points in additional cuts. So with the divergence that we'll see, and specifically if the Fed is more hawkish today, look for that drop right into that major key support. All right, Bill, here's what the scalp looks like for the Kiwi. I don't really have any scalp targets below this level. The only thing that I wanted to highlight again is that 68.90 region that we just looked at on the daily chart, and the current operative slope that we're in. I mean, there's not much you can do as far as trying to get near-term scalp targets on a low that is a multi-year low. So on the rebound, you'll just want to take a basic retracement off that low. This is not even in play anymore, but this is a major key area of support. I would expect to see maybe a rebound back into the median line parallel. If not, 71 would be a nice area. The former low day close, which was 70.86. Make sense, Bill? We're on the same page? Says great. Right on. Right on. So guys, we got about 5 minutes left. If anyone has any specific pairs, getting too excited, and it's not even FOMC yet. See that, guys? Feel free to throw them on the message board. Just a quick run through on the commodity space. Here's what gold looks like. Gold is coiled, guys. Something's got to give here. The broader bias hasn't changed. Again, there's a gold update every single day on the intraday chart, guys. It's not necessarily an intraday scalping setup, but for me, it's just a trade that I've always followed on a daily basis for years and years and years. So it'll always be updated here. How accurate are credit swaps, and where to find Swiss credit? So Bill, that information won't likely be available to the retail base. That's on the Bloomberg terminal. It's proprietary information that they provide for bank research and such. It's not an accurate thing, Bill. You can't gauge accuracy or not. It's just what the market's pricing in. It has no bearing on what's actually going to happen in policy. And you can't even gauge the accuracy of it by saying, the Credit Suisse overnight swaps has been accurate with what the Fed is doing or not. All it's doing is telling you what the market's factoring in. Markets are based on asymmetric information. So inherently, trying to gauge the accuracy of it is not going to be a drill that'll be helpful. All I want to know is what is the consensus. So if we look at this right now, and I'm looking at the Kiwi dollar, and I'm looking at a 52% chance for interest rate cut, that means heading into the interest rate decision for the RBNZ, the risk is if they don't cut. That's what it tells me. Because it looks like markets already factored in 52% that they're going to cut. So it looks like the risk is if they don't, and that'll tell me an indication of what I should be looking for in price. Right, Bill? Don't look at this as a predictor of what the central bank's going to do. Look at it as just how the market is interpreting what the central bank's going to do. So again, don't put too much emphasis on this. And Bill, whenever you need this, man, you can always just come and ask me or Jamie, and we can bring it up for you. It's not a big deal. I wouldn't go sign up for a Bloomberg terminal just for Credit Suisse overnight swaps. But I hope that helps, Bill. Mike, your view on sterling CAD again, please. A move into 95.55 again would be good or has it stuck? 30-minute RSI is very high, and the 5-minute RSI is bouncing back above 50. GS, sterling CAD, right? What a beast. So I think that's all the validation you need, what you're seeing here today. So remember last time on Tuesday we highlighted this setup. I don't know if it was Tuesday or Monday. Sterling CAD. Tuesday. And we were talking about the fact that, hey, coming into major resistance, guys, you better watch out. That major resistance was 192.20 into 192. Basically, you're looking at a 50% longer dated retracement, a 786 off the high, and you also had that median line parallel, which was serving as resistance. The initial topside target with a break above that was a major critical level at 92.90. Why is that important? It's the 2015 high day close that we made back here on February 25th or 24th, but it's also the 2009 high. We looked at this yesterday. We went for a tag right into that region, pulled right back, closed again in that critical resistance region. Today's move, I think, validates the break. All right, so you'll stay constructive above the median line again. You could see a pullback this deep. I wouldn't be surprised, but now you stay constructive above that. Topside objective, 95.48, 95.55. Again, a longer term trade, guys. This is not a scalp. And also keep in mind that you're working with a larger ATR here, about 156 pips on a daily basis. So keep that in mind if you're looking to near-term trade it. But I'd stay constructive. Near-term above 92. Bullish invalidation would need to be a break back below the median line. Okay, GS. So let me look at, you're saying the 30-minute. He says, thanks, not really a scalp. Yeah, this is not a scalp. Remember, we need to have the daily chart in view, because if you don't know where the broader trade is, you're going to make a mess of things scalping. So this is kind of where we ascertain our broader biases and the broader direction we're looking to trade in. Here's what the near-term chart looks like. So if we take a more objective view of this, larger, go back and price, okay, a basic 88.6 retracement of the decline off that February high has 93.94, 93.95 as resistance. That's exactly what we just went into right now. There's that 92.90 high day close, okay, and the levels are pretty clear here. These are the scalp levels that you'd be looking for. It's still going to be a wider range scalp, guys. 40 pips is still a quarter of the daily TR, but near-term support, you look for 92.90. Again, that confluence, this is a basic trendline support off last week's low. And again, that median line that we broke above, so 92.90 would be the first area of support here on the intraday. This would also be interpreted as the opening range high for the week. A break below that, you'd risk a move back into 92.90, and again, the 92 handle with the top side objectives really the same into 95 and change. Do we have that here? 95.40, 95.50, yep. So GS, some near-term targets for you as a reference, but broadly speaking on this type of trade where we're constructive the sterling and we're constructive the CAD, right? Dollar CAD is our favorite move to the downside. I'm a little bit cautious here on the sterling rally. Sterling has plowed against every single pair. So there's sterling CAD. I saw a question here on sterling key. Andrew says sterling key up 600 pips. GS, you're more than welcome. I hope that helps. If you have any specific questions, GS, please don't hesitate. Feel free to follow up. Andrew says sterling key up 600 pips. How far up do you think we will go? Questions like that are very difficult, Andrew. How far up do you think you'll go is not a question you should be asking. I think the question you want to be asking is where's resistance, right? Andrew, it could go up another 1,200 pips. I don't know how far it can go up. All I want to know is where's resistance. So sterling key looks like this. I have resistance at 122 or excuse me 227.63, and that's a 2618 extension from the advance off the lows. The reason you have validation on those levels, guys, is because you've seen other Fibonacci ratios hold. This might not be like the biggest wave for you to think, oh, those levels are going to be critical, but look what happened with the 1618. Literally to the pip, it caught that rally on the 5th, which turned down for a couple of days before this break. So there's a 2618 of that same formation. It comes up at 227.62, like I said. Also, the upper median line parallel comes just above that. So this is the first area of resistance you might look to see some kickback for sterling key. Right into that region. I'm not interested in playing the short side as long as this momentum signature stays in overbought condition. Remember, this can stay up here for an entire month, and you will get massacred trying to fight that. Okay, so for me, I'm going to be waiting for either a break below 70 before any type of correctionary stance is taken. Other than that, you're looking to buy pullbacks. At this point, where can you buy? It's really nowhere near where we are right now. Even the opening range low for the week, you have to be looking for a drop into like 2150. So the ship has sailed here. I don't look for anything from the long side from a scalp perspective yet. We need to see a little bit more back and forth action for us to be a little bit more comfortable trying to take a long against any concerted low as it stands right now. Watch for resistance into 227.62, basically the upper median line parallel here at the 28 handle. Andrew, does that help? Never underestimate, man. 600 pips might seem a lot to you, man, but this is giving 258 pips on a daily basis, right? So what's 600 pips? Nothing. This is one of those exotic pairs that really give you some nice stretches. Another one is sterling yen I'll be looking at with some great interest, especially if the British pound gives us some sort of near-term correction and dollar yen does give us the downside move. Sterling yen looks very interesting up near 196.46, 196.30, this region here. You're basically looking at a very similar setup to what we're looking at on the sterling key. Okay, there's your 1618 extension, upper median line parallel, except here we also have the monthly pivot even that's stretching into that, and a former lower median line parallel now serving resistance. So an area of which for the sterling yen would be an interesting hold. Also, the momentum isn't quite as high in overbought territory, so you would get that 70 crack much closer in time than you would, I think, on the sterling key. Also, a tighter ATR, 152 pips is what you're looking at, but there's a major key resistance there on sterling yen to the upside. Kelly says, sorry, one more thing. Were you going to tell us why you can see that Aussie dollar may continue higher? Thank you. Oh, Kelly, I think I was on that time frame. I was on that mind thought earlier, or that thought process earlier, right? Same thing that we're looking at with the euro. I think I segued and I gave you the excuse for the euro. Same exact thing. The broader setup here has a couple of things that has me concerned. A, we held the low day close with precision. That type of thing is perfect when you're seeing a test of a major key support, especially if it's the yearly low and it's the yearly low day close. The reaction we've gotten off that has been pretty strong. Also, momentum, 40 hold, right? 40 hold. So there's a lot of things here to suggest that, yeah, near term, you might not want to necessarily be looking for the Aussie to follow Kiwi into oblivion, okay? Not only that, but Aussie Key. Someone asked about that earlier. We are way over on time, guys, so I have to whiz through this real quick, but Aussie Key is in a very concerted, strong uptrend, right? So if we plow through 111 here, I don't even have anything on tap till 112.20. Okay, it's another 120 pips up. Near-term support doesn't come into 111, or 110 rather, but you get the picture, right? The broader uptrend, and this is something, again, everyone who's calling for the Aussie Kiwi to go, well, let me say this: Aussie Kiwi's at multi-year lows, and it hit multi-year lows this year. A lot of the fundamental guys still continue to say that the Aussie Kiwi remains a very heavily short trade. I don't see the reasoning behind that, and even now, okay, if we just look back at what we just talked about with the overnight swaps and the like, even from a fundamental standpoint, I can't argue that Aussie Key belongs lower. Even from a fundamental standpoint, guys, the interest rate expectations are for further cuts from the RBNZ, not so much from the RBA. So I just don't understand that call. In general, based on the technical structure that we're seeing here, also for the Aussie Key, again, this looks like it may have completed 5 waves, so you would look for a possible pullback here. But in general, on that premise, I don't think that the Aussie is necessarily, the bearish trade that we came into 2014 expecting, or 2015 expecting. And with the basing that we've been making on these pullbacks, obviously some serious divergence. And then on the pullback here, finding support at 40, it suggests that, that broader downtrend may not be in play right now, may not be in play. And I'd be more interested in trying to assert the downtrend again, more like near 79.50 or the 80 handle, than trying to press any type of short from here. So Kelly, hope that helped. She says that was great. You're more than welcome. Thank you. Guys, best of luck trading today's FOMC interest rate decision. Like I said, we'll keep you updated on the SB Squawk. Also, be mindful that a quick housekeeping note, Jamie's midweek strategy webinar, we pushed that back till tomorrow. Obviously, for Jamie's trading strategy, guys, the crazy volatility that you'll see is not going to be something near term that will be beneficial to you during his webinar. So he's going to push that webinar till tomorrow, same time, 1 o'clock. We'll be up here again tomorrow at 8 o'clock, 8:30 rather, to cover the aftermath of the FOMC and cover positioning on where we're looking heading into the close of the week. Best of luck trading, and we'll see you all tomorrow, guys. Thanks again. Cheers.